Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Revenue and expense accounts. Revenue and expense accounts are two types of accounts that are used to record the income and expenses of a business. Revenue accounts show the amount of money that a business earns from its activities, such as sales, services, interest, or rent. Expense accounts show the amount of money that a business spends to operate, such as wages, rent, utilities, or supplies. Revenue and expense accounts are temporary accounts, which means that they are closed at the end of each accounting period and their balances are transferred to the income statement. The difference between the total revenue and the total expense is the net income, or net loss of the business for that period. Revenue and expense accounts are two important categories of accounts used in accounting to track a company's income and expenses. They play a crucial role in determining a company's profitability and are essential for preparing financial statements. In this article, we will explore revenue and expense accounts, their definitions, and how they are recorded and reported in financial statements. Revenue accounts. Revenue accounts represent the income earned by a company from its primary business activities. Revenue is generated through the sale of goods or services to customers. Examples of revenue accounts include sales revenue, service revenue, interest income, and rental income. When revenue is earned, it is recorded as a credit entry in the respective revenue account. This credit entry increases the balance of the revenue account, reflecting the increase in income. Revenue accounts are temporary accounts that are closed at the end of an accounting period by transferring their balances to the retained earnings or owner's equity account. Expense accounts. Expense accounts, on the other hand, track the costs incurred by a company in its operations. Expenses represent the outflow of economic resources or the incurrence of obligations to generate revenue. Common expense accounts include salaries and wages, rent expense, utility expense, advertising expense, and cost of goods sold (COGS). When expenses are incurred, they are recorded as debit entries in the respective expense accounts. This debit entry increases the balance of the expense account, reflecting the increase in expenses. Similar to revenue accounts, expense accounts are temporary accounts that are closed at the end of an accounting period by transferring their balances to the retained earnings or owner's equity account. Relationship between revenue and expense accounts. Revenue and expense accounts are closely related and impact a company's profitability. Revenue accounts represent the inflow of income, while expense accounts represent the outflow of costs. The difference between total revenues and total expenses determines the company's net income or net loss. If total revenue exceeds total expenses, the company generates a net income, indicating profitability. In this case, the net income is recorded as an increase in the retained earnings or owner's equity account. Conversely, if total expenses exceed total revenue, the company incurs a net loss, indicating a lack of profitability. The net loss is recorded as a decrease in the retained earnings or owner's equity account. Financial statement presentation. Revenue and expense accounts play a crucial role in the preparation of financial statements, including the income statement and statement of retained earnings, or statement of owner's equity. The income statement presents the company's revenues, expenses, and net income or net loss for a specific period, providing insights into its profitability. On the income statement, revenues are listed at the top, followed by the expenses. The total expenses are then deducted from the total revenues to calculate the net income or net loss. The statement of retained earnings, or statement of owner's equity, shows the changes in the retained earnings or owner's equity account during a specific period. Net income increases the retained earnings or owner's equity, while net loss decreases it. Conclusion. Revenue and expense accounts are integral components of accounting that track a company's income and expenses. Revenue accounts record the income generated from the company's primary activities, while expense accounts track the costs incurred in its operations. Understanding and accurately recording revenue and expense transactions are essential for determining profitability, preparing financial statements, and providing insights into a company's financial performance.